Hello, this is Books of the Stock Market. How's everyone doing? As for me, I came back from my morning run and it was pretty cold. I also think I might need some new running shoes as they seem to be worn out. I rotate two pairs of shoes and I think that I have to change them out every 6 months. I don't know if that is pretty often or not, but yeah. Other than that, not much else has been going on, so let's get on to the reason why everyone is here. In the last video, we talked about trends, support, and resistance. For this video, we're finally going to step away from defining theories and definitions, and we're going to learn how to do technical analysis. This video will go over trend lines, more specifically, how to create trend lines. The topic on trend lines will be divided into two videos as it is a very important topic for technical analysis, and there is no way I can fit this into a 10 to 15 minute video. Let's first define two types of trend lines. The first type of trend line we will be going over is the uptrend line. So what is an uptrend line? An uptrend line is a straight upward pointing line that is made from higher lows. The second type of trend line is the opposite of the uptrend line. This trend line is called a downtrend line. A downtrend line is just a straight downward pointing line that is made from lower highs. If these two definitions don't make sense, don't worry, I'll be showing you an example for each of them. So the picture below shows an uptrend line that I drew on SPY, which is an ETF that tracks the S&P 500. Shown below is a candlesticks chart with a 4-hour time frame, so this means that each candlestick represents a 4-hour time period. And the uptrend line is the purple dotted line, and we see that it is a line that has a positive slope, which matches the definition. The uptrend line is always below the graph as it is defined as being made up of higher lows. For instance, this uptrend line was formed by creating a line from 3 higher lows as represented in the purple box. Looking from the left to the right, each box is higher than the previous box, meaning that a higher low was made. As for this graph represents the same stock, but I drew a trend line that was formed in the month of March. And it's the same setup, so it still has the same 4-hour time frame for each candlestick. Anyways, this graph represents a downtrend line. This can be observed in the purple dotted line, and we see that it has a negative slope. The downtrend line is always above the graph because it is formed by lower highs. For instance, this downtrend line was formed by creating a line from 4 higher lows as shown in the purple boxes. Looking from left to right, each box is lower than the previous box, meaning that a lower high has been formed. Now we know what up and down trend lines are and the general idea of how to draw them. Let's move on to how to meet the criteria for drawing trend lines. The first rule to remember is that it is very hard to draw the perfect trend line, and more often than not, they must be redrawn. They must be redrawn because price action may not always follow your trend line, so you must adjust them when price action suddenly rises or falls. They can be redrawn by connecting the new higher low or the new lower high with its respective previous higher low or the lower high. The second rule to remember is that there must be a trend present. As discussed extensively in a previous video, an uptrend is when the stock consistently makes higher lows, and a downtrend is when the stock consistently makes lower highs. As for sideways price action, we don't usually draw trend lines when there's a horizontal trend or when the stock is moving sideways within a certain price range. And if these concepts don't sound familiar, watch the video that I linked below in the comment section. The final rule to remember is that trend lines must account for all price action. As you have seen in my previous two examples, my graph was made of candlesticks and not a line graph. Since the line graph only tells us about closing prices, it is not sufficient when making trend lines. An alternative to candlesticks will be the bar chart. More importantly, however, since we are talking about taking into account of all price action, the trend line must be drawn at the wicks for the candlesticks and the highs and the lows for the bar chart. Now that we got the rules out of the way, we can discuss the validity of a trend line. In the previous slides, we talked about a trend line only having to be made up of 2 points, whether that be 2 higher lows or 2 lower highs. This trend line is called a tentative trend line. We know that a tentative trend line has some validity when 3 points align. For instance, in an uptrend, this sort of graph will show up where there are 3 consecutive higher lows. On the other hand, in a downtrend, this sort of graph will show up, as there are 3 consecutive lower highs. Now we'll be moving on to determining the strength of a trend line. So there are 2 factors that play into the role of determining the strength of a trend line. The first factor is how long has a trend line been intact. This means the duration at which the trend line was not broken. The second factor is how many times the trend line has been tested. This means how many bounces or touches the price hit the trend line. Let's look at these 2 graphs that I showed before. The graph on the left shows the uptrend line, and we see that the trend line held for about a month. We can also see there are 3 touches or 3 bounces off the trend line. The graph on the right shows the downtrend line, and we see that the trend line also held up for a month. We can also see there are 4 touches or 4 bounces off the trend line. So which of the 2 trend lines was stronger? We can say that the downtrend line was a little bit stronger, as the duration of these 2 graphs were about the same, but the number of touches on the downtrend line was 1 greater than the uptrend line. Now we'll be moving on to the topic of what happens when trend lines break. First, let's look at what to do when there are small trendline penetrations. The answer to small trendline penetration is that there really is no clear-cut answer. It all matters depending on the situation you're in. For instance, is the trendline very strong, or did the penetration just happen during trading hours? However, what we can say for sure is that we can ignore small penetrations if the market continues to verify the trend line. As mentioned before, it's tough to determine what kind of penetrations cause a trend line to be broken, so I'll talk about 3 guidelines that may help you on that decision. So the first guideline is that breaks that happen at close are more important than intraday penetrations. For instance, most of the time you can ignore intraday penetrations when you maintain the trend line at close. The second guideline is the 3% penetration rule I talked about in my previous video. Basically, the 3% penetration rule states that if price moves away from a trend line in any 3% direction, the trend line is no longer valid. I'll also link the video in the comment section below that talks about this rule more extensively. The third guideline is based on time. This guideline states if a trend line is not valid after 2 days, the trend line is broken. But once again, it is important to note that determining if a trend line is broken is all situational. Now, let's move on to the topic of what happens when trend lines are actually broken. So, if a trend line is broken, the trend line reverses roles. For instance, an uptrend line, which was a support line, will become a resistance line once it's broken. Likewise, a downtrend line, which was a resistance line, will become a support line once it's broken. Let's look at an example. So the graph below is of the stock QQQ, which is an ETF that mirrors the Nasdaq. We see that up till late August and early September, the line was an uptrend line. This means that the trend line was also a support line, as we see the price bounce off from here. We see prices bounce off from here around 5 times as shown in the purple box. Once the trend line was broken in early September, we see that the line has become resistance. As price gets rejected at that line, we can see 2 rejections as shown in the blue boxes. Now, let's move on to the topic of what to do after the trend lines are broken and price has moved appropriately. Once trend lines are broken, we should apply the fan principle. So what is the fan principle? The fan principle is when the technical analyst will draw new trend lines that adjust for new contrarian price movement. If the third trend line is drawn and broken, this means that there is a reversal. If this sounds kind of confusing, don't worry. I'll have an example coming right up. Here, we see stock QQQ. In the month of March, we saw the stock market drop due to the coronavirus. However, if we use the fan principle, we could have timed a safe entry. For instance, when the drop happened, the technical analyst needed to draw a new trend line. We see that the first trend line that should have been drawn was the purple downtrend line. The typical price action we see when a new trend line is drawn is first a test of the trend line and then getting rejected by it, as shown in the purple triangle. Second, there would be a break, as shown in the purple square. Once this first trend line was broken, a second trend line should have been drawn, as shown in the blue line. We see that it was once again rejected at the blue triangle, then was able to break it at the blue square. Once this trend line was broken, a third trend line should have been drawn, as shown in the green line. This trendline once again observes similar price action where the green triangle represents the rejection and the green square represents the breakthrough. Once this trendline was broken, the fan principle states that it is safe enough to buy in, and this was confirmed by later price action as price has recovered to all-time highs. The final topic we will be talking about is the degree at which the trendline is formed. If the trendline is greater than 45 degrees, then the price action is too steep and it can't be sustained. This means that there will be a price drop near the future. On the other hand, if the trendline is less than 45 degrees, then the price action is not strong enough, so we can conclude that this is a weak trend. For instance, here we see the purple line is too steep, while the green line is not steep enough. A healthy trendline will be around the black line, which represents the 45-degree angle. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. In this video, we learned about trendlines, which is fundamental to technical analysis. The next video will be continuing on the topic of trendlines, especially the important topic that you may have noticed that was missing, like how does price react when trendlines break? So if you don't want to miss out on these topics, subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports this channel. If you have any questions, leave a comment below and I'll try my best to answer all of them. Well, this is Books of the Stock Market. I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.